Welcome to the Long-Term Investor. Today with me is Sam Adams, CEO and co-founder of Vert Asset Management, which is a dedicated ESG investment management firm. And today we're going to be talking all things ESG. Sam, thank you so much for joining me here today.
Well, thank you very much for having me, Peter. It's great to be on.
You have a wonderful book, which I read, that you co-authored with Larry Swedroe called Your Essential Guide to Sustainable Investing. And really, I think the marketplace was missing a book like this, something that introduces all the issues and all the history and considerations. I think you did a wonderful job with it, and we're going to get into some of the content from that book in this conversation. But before we do that, I would love if you just shared with the audience a little bit of what drew you personally to sustainable investing in the first place.
Well, I'm a climber and a skier, Peter, so I've spent a lot of time growing up in the mountains and spending time in the mountains with my kids, and I've seen the ravages of climate change. There's a lot less snow than there used to be, so there's a lot less skiing than there was before, and so I've always wanted to do something about that if I could, but really, you know, for the longest time, I thought it was only philanthropy, just donating to environmental causes and doing what I could. But I worked in the investment management business. I worked for Dimensional Fund Advisors for almost 20 years. And of course, Dimensional is a free market think tank, pro-capitalism, University of Chicago, and environmentalism and capitalism were kind of at odds for each other. The environmentalists were saying turn off capitalism in order to save the planet, and that didn't resonate with me. So when I found ESG, or environmental, social, and governance investing, and it was a way to turn capitalism and companies towards focusing on solutions to climate change, I got really, really excited, and I decided that's what I wanted to do for the rest of my life. So I left Dimensional and started Vert Asset Management, which is a dedicated sustainable investment manager.
Well, and one of the things that I've always appreciated about the company that you started is there's such a focus on education as well. I mean, even as PlanCorp was putting together their first set of ESG portfolios, we spoke to you at length about a number of the different issues, and there are a lot of confusing terms. So many things sound the same. And I thought maybe we could start there, just level set for the audience. And you identify 3 types of sustainable investing. Maybe you could just run through those and give a couple quick examples so that we're all on the same page here for this conversation.
Yeah, as sustainable investing has gotten more popular, the industry and the media has largely erased the original meanings of the terms we used to rely on to help us differentiate between the different types. And of course, there are thousands of different ways to invest for sustainability, but we think you can bucket them into 3 main categories, and we call those ESG, SRI, and impact investing. Now, the oldest one is SRI investing. That's been around for hundreds, maybe thousands of years. And that's where someone wants to be an investor and maximize their total return, but they have some no-go areas, right? So they are socially responsible because they have an issue with alcohol or tobacco or gambling or adult entertainment or whatever their issue might be. They just say, I just can't have that in my portfolio. It's against my morals. It's against my ethics. It's against my religion. So they take it out. So that's the original form of SRI, or socially responsible investing. The next category is impact investing, and that's where you're really taking catalytic capital and you're putting it into a single project or a single company, and you're saying, hey, I'd like to solve this problem. It's kind of like a for-profit version of philanthropy. Like, I was donating money to that cause. It wasn't really solving the problem. Maybe I could use impact investing to do that. You might have heard the phrase, if you give a man a fish, he eats for a day. If you teach a man to fish, he eats for a lifetime. This is give that man some capital. Maybe he can buy a boat, hire some fishermen, and start a fishing business that feeds the village for a lifetime. That's kind of the idea around impact investing. Now, the latest entrant is ESG. It's only about 15, 20 years old, and it's using environmental issues, social impacts, and governance, how a company manages its own affairs, to identify risks and opportunities that companies face around people, planet, and profit. And that's a very different way of investing, but still sustainable, because the sustainably minded person, right, likes the fact of investing in companies that are doing better for people and planet.
Well, I love those categorizations. And in the book, you cover some of the motivations behind why people would do this. You point out financial, societal, and personal motivations or benefits of sustainable investing. And I'd like to explore these three different things, starting with the financial return side, because I think people are sometimes confused by what to expect in terms of financial returns from sustainable investing. So you just laid out three fairly different styles of sustainable investing. That choice alone is probably going to have the greatest implication for your range of financial outcomes. So let's start with impact investing. What should an investor expect in this style of sustainable investing?
Yeah, well, in our definition of impact investing, where it's really private placements or private equity or private debt, the returns are all over the map. They literally range from minus 100% to 10 times your investment. Right? They could be anywhere. Right? So once I invested in a crowdfunding platform, and I chose to send a couple of $100 to a Peruvian village who wanted to certify their coffee beans to be organic. Then they could charge more for their beans, and they would be better off. I like coffee. I like organic things, so I invested in that, and it worked. They managed to certify their beans. They repaid the loan. I got the money back into my crowdfunding platform. I was like, "Oh, this is great!" But before I was able to reinvest it into another impact investment, the crowdfunding platform went bust, and they sent me an email saying, "Would you like to have us wire the money back into your bank account, or would you like to contribute those funds to our winding up costs?" And I said, "Well, I'll contribute to your bankruptcy." And my impact investment became a philanthropy, right? That's kind of what can happen with impact investing. Now, there's impact investors who are investing in like nuclear fusion, right? And so they could lose a lot of money for a long time, then they could make tons of money. And then there's more traditional forms of impact investing where you invest in affordable housing or microfinance, and your returns are just slightly under market returns. If that note would pay 4% on the open market, you're getting 3.5%. And so the returns for impact investing really are all over the place.
And so is it fair to say that if you are classifying yourself as an impact investor, that the financial return isn't quite as important to you? It's, as you mentioned, in some cases it can become philanthropic just because there isn't return. But for people who are doing impact investing, they hope to get some sort of financial return, but they go in knowing that a financial return may not materialize. Is that a fair way to characterize it?
Yes. And also, if they do get a financial return, you typically see them pile that back into more impact projects, right? This is working. I want to do more with this, right? So let's scale up the impact that we're having.
Now, with SRI, or socially responsible investing, and ESG, environmental, social, and governance-based investing, that can be more easily implemented to the public market. So how does that impact the range of outcomes you might see in those two strategies?
Yeah, they're typically much closer to what you'd expect from a conventional investment into public equities or bonds, right? There's some differences, though. SRI investors typically exclude things like we talked about before, the sin stocks of alcohol, tobacco, gambling, pornography. Those industries, those products tend to do well. They're riskier. People dislike them. They have higher returns, at least over the last 80 or 100 years. And so if you're systematically excluding those higher returning parts of the market, you get slightly lower returns for an SRI strategy. And traditionally anyways, SRI strategies were expensive in terms of fees. They were actively managed. And so, you'd have a drag on returns of 1% or 2% there for your SRI strategy. Now, that might be worth it for people who are saying, listen, I got cancer in my family. I don't want to invest in tobacco no matter what. That's totally fine, right? ESG, different, right? ESG is using what the company's risks and opportunities are around environmental, social, and governance issues. And so there isn't necessarily that drag on performance from systematically excluding things. And of course, now there are ESG index and low-cost strategies. So less of a drag on performance in ESG.
And there's a quote from the book. It's more than a quote. It's maybe a passage that I felt like really resonated with me. So I'm going to go ahead and read the entire thing. You say most modern ESG strategies are not based on what is individually important to the investor. Instead, they're about what is important to the investments. Companies are selected based on how they're dealing with the environmental, social, and governance issues most likely to affect them financially. It is more of an investment-led strategy rather than a client-led strategies of SRI and impact investing. As a result, ESG strategies can be used by many people because they're not tailored to any individual in particular. And Sam, I think one of the things I struggled with as an allocator for many clients in this issue was, as we were building our ESG portfolios, we realized that they couldn't be everything to everyone, but that you could have a more predictable set of risk and return characteristics by using an ESG strategy. And then if people want to tailor beyond that, perhaps they can use a separately managed account or use a thematic ETF of some sort. So, I think that characterization on the differences between ESG versus SRI and impact investing is really informative. We've kind of nailed down the financial returns here. I think the other common question that I'm faced with when presenting the idea of an ESG portfolio to a prospective client or to a current client is, does this type of investing, any of the three styles, actually have any impact? How would you describe the social returns of these three different styles of sustainable investing?
Yeah, they're very different. And so it's important to understand what they are and then decide where you want to invest, and maybe across all three different types. But there's a great paper, academic paper, with a wonderful title called "Can Sustainable Investing Save the World?" And they do a typical academic work of breaking down the problem and the potential solutions. And the way that sustainable investing has a societal return or an impact, how it changes corporate behavior, they break into three different categories. The first is capital impacts. Does the flow of the money change the ability of the company to do things or not do things, right? So are green firms winning more capital, getting allocated more capital so that it changes their cost of capital, they can do more projects or not? Secondly, there's active shareholder engagement, right? This is shareholder advocacy. Does the investment manager use their power as a collective shareholder to encourage the companies to do better through proxy voting, through shareholder activism, all different kinds of things? That's the second way. And then the third way, which is really hard to measure but might be one of the most important ways, is indirect effects, which they loosely group into things like benchmarking, and I call it naming and shaming, right? I'll give an example from the 90s. At one point, BMW was considered the most sustainable car company. And then they lost that title to Volkswagen. Of course, these two German engineering automobile firms are rivals, right? And so BMW was not going to let that happen, that Volkswagen was going to be number one. So they doubled down on their sustainability efforts so they could take the title again, right? Well, that's the kind of thing that you want to see, right? And then there's the flip side where, an organization like Greenpeace will write a report and shame all of the data centers that are profligate users of energy and creating huge amounts of emissions, and then the industry cleans up its act, like those types of things, right? So those three mechanisms, the capital flows, the shareholder advocacy, and the indirect or naming and shaming, can have big impacts, but very different. If you're, for example, an SRI investor, your capital flows are not going to change public markets because there's not a lot of people with your particular set of specific issues. With ESG, you might. If enough people, it's now a third of all professionally managed money around the world is invested for ESG, companies are starting to respond to that probably, right? And of course, shareholder advocacy, if your SRI manager does that, you could be impacting things. A lot of ESG managers do it, some don't. So it comes down to choosing which manager if you want that shareholder advocacy piece.
Well, and you mentioned that capitalism sometimes people feel like can go too far, and that capitalism can evolve if this is sort of what is impacting the cost of capital at some point. And I think that stat that you threw out there, and it's in the book tucked in there somewhere, that about a third of managed money has this focus, probably would surprise a lot of people, and in part because there is some evidence and maybe we'll get into this later, of how you could enhance returns, integrating some of this information into it. And so I imagine that constitutes some of that number as well. But kind of a related point, you talk about the personal return of these different styles and how they differ. But the one thing that really resonated with me was that, being part of the solution is a reason that people might choose to do this. And when we know that there's a lot of things that we do day to day that are bad for the environment, like driving, well, I'm not going to give up driving. But if there's something I can do that's easy, I'll choose the sustainable option. I will tell you, Sam, I hate those paper straws. Those paper straws drive me nuts. Now, it isn't that difficult. And, when someone hands you a beverage with a paper straw, you kind of just have to take it. But gosh, I hope there's a better solution, because most of us are going to choose a sustainable option these days if it's easy. And I thought that was really an interesting point. I don't know if there's anything else you can add to that on kind of the personal returns to investing sustainably.
Well, it's funny when they come up with solutions to these problems, right? So the solution to the paper straw is the metal straw. And my wife and I's mental image of that straw going through the back of our children's throats means we just can't have, the way those guys wrestle, our boys wrestle, I'm like, there's no metal straws in our life. So yeah, I hear you. So that's what people do, right? They trade, they want to be part of the solution rather than part of the problem. So they look around their lives and, can I recycle? Can I compost? Can I do these different types of things? We recently moved from Northern California to Southern California, and the options available for us for doing different things are very different. And so we've had to change some of those because it can't be too disruptive to your lives, right? And for a long time, when sustainable investing was just SRI investing and you were probably going to underperform, that was too disruptive. It was, people say, I can't do that. But now with some ESG investing strategies that can also match your asset allocation the way you've always done it in the past, it's a lot easier for people to do, right? So this is kind of a trite analogy, but if I have a Coke can that I need to dispose of, right? If there's a recycling bin right next to the trash can, I'm going to put it in the recycling bin. I don't know how long I'll carry it around if I can't find a recycling bin for like a week or so. Am I holding that Coke can until I can dispose of it? But when it's easy, more people will do it. And that's what's happened with ESG investing. Now there's, you have a large value strategy that's conventional. Now there's a large value strategy that's ESG. And so people can put their money there almost just as easily. And so that's driving a lot of the adoption. It's a lot easier for people to do. And again, it's just that feeling like I want to be contributing. I want to be doing my part. I know I'm not saving the whales here, but it's kind of like putting that Coke can in the right thing. At least I'm voting for the right thing here, okay? And that's the general feeling.
That makes a lot of sense to me. And I appreciate this background because I think, again, there are all these different terms and people want to understand not just what the different things are, but how they will impact their returns, how they'll actually impact the world, how it will impact their own behaviors and their own thoughts about their investment portfolio. You do spend some time in the book going through different ways to implement different strategies. And I think this is where sometimes I believe that the confusion, not just within investors, but with advisors, starts to crop up because there are so many different methods to applying methods that you can apply to these different styles of investing. And so as I'm talking here, say I'm mostly going to lean on ESG is what I'm focused on, but I was sort of hoping that we could go through some of these methods. I actually also did a podcast long ago that you pointed out to me, Sam. I've done so many episodes that I've forgotten what episodes I have and haven't done. But if you want to go back and listen to episode 13, I touch on a little of this as well. And I'll be sure to link to that and a related blog post in the show notes at thelongterminvestor.com. But here we're going to run through some of these methods that you outline in the book. There are 7, 2 of which I might combine here in the conversation. But the first is negative screening. So let's say we have an SRI strategy or an ESG strategy that uses negative screening. Sam, what does that mean exactly?
Well, so the SRI is pretty straightforward. A person has a problem alcohol or tobacco or something like that. They just want it taken out of their portfolio. So they'll either look for mutual funds or ETFs that systematically exclude those. On an ESG basis, it might be something like any company, like this is what we do in our real estate strategy, any company that is not adequately addressing the physical climate risks to their buildings, right? They're not paying attention to sea level rise or to heat stress or to drought. They're not paying attention to those risks. We don't want to invest in them. So we'll systematically screen those companies out.
And sometimes people will refer to negative screening as exclusionary. The opposite of that is positive screening. So can you give us some examples and definition of positive screening?
Yeah, so in SRI, you might find a strategy like a vegan strategy or a pro-human rights strategy, and they'll find companies that are doing well on that or whose mission is to advance those causes. On an ESG strategy, it's like, okay, well, let's tilt the portfolio more or include companies that are coming up with renewable energy solutions or energy efficiency solutions or have a product or service that is ameliorating climate change. Those are all examples of positive screening. There's also kind of rankings, so I'm going to take the top quartile or the top decile of firms on this certain particular ranking. For example, we use, if you're in the top decile of having green building certifications across your portfolio, then we can include you in the portfolio as a positive screen there.
Well, and another common term I see thrown around is best in class. And as it pertains to a stock portfolio, for example, if you use exclusionary of anybody who's involved in fossil fuels, well, then you might lose all of energy. You might just end up with a portfolio of technology and financials, whereas best in class recognizes, or this positive screening approach recognizes, that you could only own the best in those different industries to give you a little bit more diversification and a little less differences in return from just a traditional index. This third approach that you highlight in the book called integration is sort of what I was referring to earlier, in that a lot of people use this approach and then call their fund ESG or they just use it within the financial analysis. But maybe you could give a little bit of a definition with integration, as well as if you think there are any issues out there with people using the term or classifying themselves as such.
Yeah, this is by far the largest category, ESG integration, because people who aren't really doing ESG at all, right, but they excluded like a couple of oil companies they didn't like anyways, they can say we're ESG integrated, all the way to people who are like really investing in just climate solutions. They're like, we're integrating ESG, right? So it's too broad of a category, and so it's just it captures a lot. So there's some greenwashers in there, but there's some ones that are really meaningful. But one of the things that's going to make this difficult to parse out is the fact that very, very large institutional investors have recognized that some of these ESG issues are material risks to the portfolio, whether or not they're sustainability minded or not, right? And physical climate risk is a good example of that. If you have a hotel on the beach in Miami, sea level rise is an issue whether you care about sustainability or not, right? That's just a fact. And so are you integrating climate risk into your portfolio analysis or not, right? And so, some people go so far as to say all investors will be ESG investors through time because these are more material risks. And there's a spectrum there of how much people are tilting or leaning into sustainability or not. So again, that's a very loose and poorly defined category.
Yeah, well, and I would think if integration is really just incorporating ESG data or information, incorporating more information into financial analysis, I would hope any manager that I'm allocating to would take into account anything that has material risk to it, right? Whether you're managing, I realize some of the data isn't always perfect, but I would hope that that's going on, and maybe it'll more and more so as the data gets better.
Well, and that's actually our theory of change around this, right? We actually think that that's the reason why we want to do more ESG investing. We would like markets to be more transparent. We would like companies to disclose more. We would like more information priced into the capital markets. That just makes markets more efficient and better for companies and investors. And so to the extent that we can get this ESG data factored into prices, that's pricing externalities, that's fixing some of these issues that we have, and having the market lead those through the pricing mechanism.
Well, and I don't want to totally veer off of these different methods, but I think I can't ignore, you made one comment earlier about greenwashing, and now you're bringing up quality of data. So I am going to jump around a little here because I think it is an important thing. It's tangentially related. It's just overall the quality of data, the way that companies self-report. How would you describe the state of ESG data today, and what do you think we can expect in the future?
This is what I love about this question, is that the answer to that question in 2005 was the exact same answer it is now in 2022, which is how's the ESG data? Oh, it's not great, but it's getting better all the time, right? Now, that answer is completely accurate and completely devoid of any informational value, right? So here's how I try and give some color to that. In 2005, we had ESG data, but we really couldn't make any distinctions between this company or that company, who was doing better on sustainability or not. We had ratings, right? There's no publicly disclosed ESG information. Companies weren't really disclosing this. And so we had to rely on firms like MSCI or Sustainalytics to give us ratings, right? So A, B, C, D, or some scale like 0 to 100 on sustainability. And those ratings are exactly like an analyst saying this stock is a buy, a hold, or a sell. They have the exact same informational value, which is close to 0, okay? But that's all we had. That was ESG 1.0. ESG 2.0 is kind of the space we should be in now, which is we've moved past ratings to materiality, and we say, okay, this company is a mining company. Health and safety is critical for their workers. How are they doing on that? We have some statistics on accident rates on them. That's a material issue for that company. It's also important for people, or the social dimension. So that's an ESG material issue. And I'm going to bring that up. We have some of those data sets now, and they can help us parse differences between companies. Better firms, better investment managers have moved into the materiality era in the way that they manage money rather than rely on ratings. ESG 3.0, which we're starting to head into, but we'd like to get there faster, is rather than just rely on companies reporting their own data in their own way, we have standardized metrics just like we do on the financial side. So I want to be able to trust a greenhouse gas emissions figure just like I trust an earnings figure, right? We're not there yet, but we're getting to the point where things will be standardized, third-party verified, and not even reported by the company. I'll give one example. You can ask an oil and gas company how much methane they leak, right? And they'll probably tell you, right? It's not much. But now we have satellites that can actually take pictures of the methane leaks from every inch of the globe almost and say, this is exactly how much methane is leaking, right? That's a different data than what the company reports, right? So we're getting there. And the standardization is taking leaps and bounds. And this year the SEC is talking about recommending that companies disclose their greenhouse gas emissions and their climate risks going forward, and that will help standardize things as well.
Well, I think this is good news when you see greater transparency, more standardization in anything that corporations report, whether they're financials or these sort of ESG measurables. So I think that's encouraging to hear that it is still improving. Another sort of tangent that you had mentioned within the realm of integration is greenwashing. Maybe just for our listeners, define what greenwashing is and how concerned or maybe not concerned should people be about greenwashing that goes on in the industry?
I love greenwashing, and that sounds like a crazy thing to say from a sustainability professional, but the thing about greenwashing that's craziest is that everyone acts so surprised about it. Like, oh my gosh, these companies are greenwashing. I'm like, have you ever sat on an earnings call, right? It's the CEO and the CFO telling you how great their company is. Oh, we got, the products are flying off the shelves. There's no risk. Everyone loves working here. That's what companies do. They put themselves out there in a good light. And same with products, right? Before we had organic, we had natural. Like, what did that mean? That didn't even mean anything, but it sounded good, right? So, in the packaging of their products, in their packaging of their firms, companies have always been greenwashing. Now there's the save the planet element to it, which is a bit over the top, right? So, yeah, first, we shouldn't be surprised that people are greenwashing. Secondly, it's a good thing that the industry is calling this out because there are companies that are saying, hey, there's a whole bunch of money going towards ESG. I'm going to slap an ESG label or integration label on my fund and capture a bunch of assets. And when they get called out, we start getting better tools to look at it and say, okay, who's actually doing this or not. Some of your longer term investors might remember when indexing got popular, right? A bunch of active managers were closet indexing, right? They were taking advantage of the higher returns of indexing by tracking the market, but they were charging their high fees, right? And it's kind of like they got called out, and now we have tools from the different researchers on how much the fund managers deviating from the benchmark. Same thing. We're getting better and better tools to say, all right, who's really greenwashing here? Who's really tilting strongly into sustainability? And let's parse out the differences.
Well, I appreciate you following me on those quick tangents, because we were talking about negative screening, positive screening, and integration. And that's where I allowed myself to get a little bit sidetracked. And I think those three approaches are by far the most popular versus some of what we're about to talk about. The next two, I don't know if you're going to say it's fairly or unfairly that I'm going to group them together. And by all means, I'd love to hear. But you have norm-based approaches, which I sort of think of as like a thematic type deal, and sustainable themed, which is more sustainable energy, sustainable water, which also to me kind of falls into a thematic bucket. So how would you describe those norm-based, those sustainable themed? I'm just trying not to have duplicate words because we're already calling it sustainable investing. Can I get rid of sustainable themed somehow by calling it thematic?
Yeah, they're very similar. It's just the question is, where's your source? Where are you getting your ideas from for the investment? If you're saying, I'm going to follow the UN Global Compact rules around anti-corruption, anti-bribery, human rights, labor issues, that's a norm-based strategy. Or we're going to follow this faith-based system, or, the Pope wrote Laudato Si, which has basically become an investment program for Catholics. If you're following something like that, that's a norms-based thematic program. If you're following a thematic program around something like renewable energy or sustainable agriculture or affordable housing, that's another form of thematic. And they are much smaller, right? ESG integration is trillions of dollars. These are measured in the billions of dollars. They're much, much smaller. And so you might say, okay, I want to take my regular portfolio, my ESG portfolio, and I like renewable energy, add a couple of percent of my portfolio into, renewable energy. That's a way to do a thematic investment program.
The other ones that you have listed in the book is impact, which again we've kind of covered in great detail. There's not a whole lot of difference in terms of talking about the approach versus the style. Is that right? Yeah, I mean, it's very different than these other ones, right? Rather than using all like negative and positive screens and integration to figure out what to invest in, you have one thing you're investing in, right? I'm trying to solve a food desert in downtown Chicago. I'm investing in one grocery store, right? This is not complicated. Well, and the final thing is corporate engagement. And Sam, I actually, anytime I'm having an initial conversation with a client or prospective client about ESG investing, I do highlight the options of corporate engagement, because people ask me that question, well, hey, how big of a difference does this make? And I go, well, your voice would be heard louder if you buy a share of all the companies you hate and get up at a shareholder meeting on the microphone and just go bananas about the issues. Yes, you will be heard differently than if you just invest this way. But there is a lot in corporate engagement that is done less about going bananas on the microphone, whether it's letter writing or proxy voting or pooling your capital together to vote shares a certain way. How would you kind of characterize corporate engagement strategies within all of this? Yeah, I mean, a lot of headlines are written about that individual strategy where a couple of fund managers got together or one shareholder got Dunkin' Donuts to stop using styrofoam in their cups, right, or something like that. Those are cool stories, and they're great. But for me, the bigger story is systematic change, right? When you get an entire asset class, like we ask every real estate investment trust in our portfolio every year to do the next thing in sustainability. Please standardize your greenhouse gas emissions disclosures. Okay, next year, please disclose your climate risk. The next year, please report on your net zero or your decarbonization targets, right? So when a whole group of investors, and they're now, like we said, over a third of all professionally managed money, is asking companies to do better on these things, to set these, to actually
disclose these things and set targets, that's when systematic change starts happening. And so what you really want is your fund manager to be participating in that part. It's cool if they go after, like get one company to stop doing palm oil deforestation. Really cool, right? But more like, let's get the whole capitalist system to start integrating this information more. Let's actually tune these risks into our portfolio. Then the CEOs and CFOs of companies, when they're launching their next product, they're not just saying, can we sell it, right? They're going to say, is the investment community going to be behind this? Right? Are they going to like the fact that we're launching this product, or are they going to give us grief about it? Those are the types of things that we want to have change.
Well, so as we start to wrap up the conversation, the last thing that I really want to focus on at a high level is some of the empirical research. There's a couple different chapters in the book that go quite deep. We don't necessarily have to go that deep, but I'm curious if you could talk a little bit about what sort of evidence is out there on sustainable investment strategies helping or hurting or not making a difference on performance.
Yeah, there's been a gold rush recently in the academic community on ESG performance studies, right? So now that there's a significant amount of money flowing into there, that's a great thing to publish on, and there's a lot of open questions. So there's evidence that says sustainable investing underperforms and evidence that says it outperforms. And that's most of that's due to the fact that we haven't completely parsed out the difference between SRI and ESG. But if you do that, you look at all the SRI studies and they say, listen, going back 80 years, we could see that tobacco outperformed, conventional products. And so SRI strategies tend to underperform. That's been pretty well established. More modern studies about ESG, which is really post-2016, really post-2017, proper ESG, we don't have enough data on, right? We don't even have 10 or 15 years of data on ESG, so we really can't make long-term conclusions over what's going to happen. From an investor perspective, you do have choices now with mutual funds and ETFs and strategies that are going to hug the market to various degrees, so you're not going to get caught out one way or the other. We just don't know enough to be able to say, this is going to outperform by 1 or 2% like a value strategy versus underperform by 1 or 2% like a growth strategy. We don't know the answers to those questions yet, unfortunately. So, the prudent thing to do from our perspective is to build a strategy that's going to track the market, whatever market you're trying to return, to a degree that you're comfortable with. Right?
Well, and I think the lack of robust data set on the more modern ESG process really places a lot of emphasis on the investor to understand the process at which a fund is choosing or not choosing securities. The process of security selection is really you have to believe in that if you know that there's certain constraints on how much returns are supposed to hug an index or how much they're allowed to deviate from an index returns. That is one thing, but I think the process comes down. It's pretty important there. I'm actually curious, because your fund focuses on real estate, a little of what that process looks like.
Yeah, that's exactly right. Because there's uncertainty in this, it actually all falls back onto the fundamentals of portfolio construction, right? The big lever is your asset allocation, right? And then once you are into your specific portfolios, like in our REIT strategy, we're delivering the market returns of publicly listed real estate investment trusts. Okay, how do we construct that portfolio? Well, we have, half the market weight, 1/4 of the names in the benchmark in that portfolio. It's going to give you about 2% tracking error, right? So, financial professionals understand, okay, I know exactly what that's going to do. It's going to give the market rate of return with a certain amount of difference every year, but it's a much more sustainable experience than, say, a conventional index fund. And that's what you can do with ESG now. And you can decide, I want to tilt really strongly into ESG, much like you would tilt to value or size, or you can do small tilts if you want to hug the benchmark more closely. But sometimes investors are scared about this. They think it's very, very different. But when you look at the fundamentals, although the way you construct the portfolio is the same way you would do with a conventional portfolio. And then it's the question at the end, how strong of a tilt do we want to sustainability? How many securities do we want to exclude? How much do we want to overweight ones? And those are things that a lot of us are very familiar with because we've done this with different factors like small and value and profitability, et cetera.
I love that you highlight that all the time when I'm showing the 3 model portfolios that we offer to different clients: indexes, factors, ESG. It is all really rules-based, low cost, transparent, low turnover, the same kind of fundamental pieces, a belief that markets work, the same fundamental pieces that drive outcomes. One more quick question on performance research. Again, there was a lot of empirical research, and I think if you really want to dive in and learn more, I'd encourage you to pick up the book. There's 2 chapters dedicated to a review of some of this past research that I think goes appropriately deep, not too deep where you lose interest. It's sometimes hard with academic research and empirical research to maintain interest, but I think it goes appropriately deep into the weeds. One of the things I really liked was the thought of how fund flows have impacted past returns or future returns. And so if we, again, all think of stocks as a way that companies attract capital, we're providing capital to a company and we expect some sort of a return. And if we think if we think for some reason that companies doing well on ESG stocks are safer or more likely to avoid risk, well then the cost of that capital should be lower. What was it that you all covered in the research that sort of talks about that theory and what implications they might have for investors?
Yeah, there's 2 streams of research here, or theories, that actually counteract each other to some degree. And let me explain those. If you said, I want a green portfolio, stocks with high performing on ESG, right? That means they have lower risks of pollution fines or labor strife or risk issues in their governance. Those are better run companies. They're going to attract more capital. They're going to become like growthy companies in a sense that they're attractive, profitable, people like them, put money in them. Their price will rise. Okay, that's great. But then their expected return should be lower over time, right? They are not alcohol, tobacco, risky companies. They're high-performing companies. So they have a higher price. They should have a lower cost of capital return through time. That's kind of what you want as a sustainable investing. For these better firms to be rewarded, they get more capital. They can fund more projects. But that means you have a lower returning portfolio, but a safer portfolio. So maybe risk-adjusted returns are similar. Now, where are we on that transition? Because are we boosting the prices of green firms right now? Right? Are they going up, or are we already past that phase and they're going to be low going forward? Right? So that's kind of the question, is the timing question. Are we in a new equilibrium, or are we not there yet? That's an open question. We don't know. Europe has over 50% of all professionally managed money integrating ESG at some level. Right? The U.S. is about a third. When you ask individual investors, 70-80% of them would like some sustainability in their portfolio. If you look at the institutional community, 7 of the 10 largest pension funds in the world integrate ESG already. So you could say there's more money to go into ESG still. We're still in the early innings. And so that repricing to the new equilibrium is still happening, and ESG firms will outperform. Or you could say we're already in the it's a safer place to be space. I guess it's up for debate there. And again, we come back to the principles of portfolio construction. Make sure that you build your portfolio to withstand either one of those outcomes, right? Because it's going to do the job that you need it to do with the tilts towards ESG that you like.
Well, Sam, one of the questions that I ask almost all my guests, I think is really pertinent given our sustainable conversation here. I'm curious, Sam, what does it mean to you to be a long-term investor?
Well, this is one of the things that is so beautiful about my switch from conventional investing with dimensional and factor investing to sustainable investing is both of them require long-term investment. If you think of any sustainability project, like buying an EV or putting solar panels on your roof, It takes an upfront initial investment, right? But it makes money over the long term, right? So you need to be, you need to be invested for the long term to have these sustainability projects pay off. And it's one of our theories of change is if companies and investors had a long-term way of thinking, they would say, hey, I want that company to switch to renewable energy. I know it's going to hurt quarterly earnings now, but in 5 years' time, they'll be saving a ton, right? And there's examples after examples after examples in the marketplace of that. So there's an exact parallel between long-term investing and sustainable investing. If you're a long-term investor, you're going to want sustainability. And if you're a sustainable investor, you're going to need to be long-term.
Great response, Sam. There has been so much useful information. As a reminder to all of you listening, you can go to the Long-Term Investor for all the show notes and resources. I'm going to have a full bio of Sam and a link to his company. Sam, is there anything else that you want our listeners to know about or how to find you?
Yeah, you can check out us out at vertasset.com. Also, the book, Your Essential Guide to Sustainable Investing, is available on Amazon, on our publisher Harriman House, on IndieBound. So grab a copy. We did write it for the individual investor in mind, though, as Peter said, those research chapters are a little heavy going sometimes. You
did a smart move by tucking them a little bit more than midway through. I think if people can't make it through those portions of the book, you will have already gotten through 4/5. So I think you're in good shape. This is a great conversation. Again, thank you so much for joining me, Sam. If you're watching on YouTube, be sure to like, subscribe, comment. It influences who we have on the show next. Until next time, though, to long-term investing.